Another day at the chart, a sea of red, talking puts and calls, but they just stare ahead. Strike price means nothing in the blank minds. Margins and leverage like mountains to climb. Spent the whole week on
Our stream here so you can see what we're doing a little bit better. Hopefully this is easier on your eyes and you can follow along more easily. So today is, what is today? Wednesday, the November 5th. And markets were down huge yesterday. Your account was down, I think around at one point like $2,300. Basically gained about half of that back in the overnight, and now you're still overall down about 800 from where you were, maybe 700, but a lot of recovery happened today. We're going to go into Russell and adjust this first because this is your largest position. I couldn't help myself. I sold some puts, or a put in the Russell for you. So we're going to go ahead and close that put. And I did make another adjustment. I rolled out your put that had 16 days, and I moved it out to like 44 days. So what we're going to do is we're going to close the 2100, and it's put it in order to buy that back for 750.
Ooh, 750.
Yep. Because we don't want that much risk on. All right, so that's closed. So that made you $150. And the reason I did that is just because we had a large down move. Volatility went up a decent amount, and I wanted to basically fade the move. You get paid a lot more when you're selling puts into down moves. So I like to put things on when the market's crashing or going down quickly, because all it takes is for that momentum to stop and you're going to get paid. So now what we're going to do is we're going to readjust our position, because we were leaning a lot longer than we are now. Actually, right now we're overall short delta in this position because of this rally today. So what we're going to do is we're going to also buy back. So go to this other put that we have that I rolled out. Oh, you're already in there? No, you're not. That's the call, dude. Go out to the 44-day cycle. Go to the put. You're going to buy that back. And then we're going to get over what we just bought back on the one that we just closed. We want to make sure that we're collecting over that much in credit. So if we take this put up to, let's say, 2375, that's going to give us about $10 in credit. 2375. Yep. That should give us around $10 or more in credit, right? Yeah, go ahead and put that through. Okay, you're filled in that. Now we're going to do another thing. We're going to take this November contract that's a call, and we're going to buy that back, and we're going to roll out to December. But you can't do that in one transaction. Thinkorswim is stupid. It still hasn't figured out how to. You can do this in Tasty, and you can, but for some reason on futures products, you have to do it in two separate transactions. So go ahead and close this out. Just remember what the mid price is there, 25.1. Go ahead and send that. You're probably not going to get filled. Oh, you did. Okay. So then now go out to the December again, and you want to sell whatever the December, the 44-day. Now go out and see where you can get that $25 in credit on that option chain. So we're basically trying to roll this for pretty much a flat or a net credit. So it looks like you can go out to the 2,600 and get $28, or you can go out to the 2625. So go to the 26 and go ahead and sell that 26, get 28.50 for it or so. Nope, you're buying. And that was the wrong strike. Yeah. Go ahead and see if you can get 26.50 or so for that. Yeah. 28.50, sorry. Awesome. Okay. So now your delta should be back in line. You were short delta with those adjustments. You should be pretty much back to flat, just tiny bit long delta. Okay. Cool, cool, cool. You were up a little bit more overall in that position. You were up, I think, at 850 at one point, but hey, c'est la vie. That big down move really kind of hurt. And I might not have adjusted. Those adjustments might not have been the best thing to do, but sometimes you don't know if the market's going to continue to go down, so you got to stay a little bit mechanical. All right, now to Tesla. All right, so with Tesla here, we're working our way up from the bottom. Let's open up Tesla. Tesla has some big news coming out tonight, so this thing could have a big down move tomorrow. You are currently what? What is that? How many points out of the money are you right now? 380 up to 356. So you're $76 out of the money. I kind of think you don't do anything in here. You just leave her be. Snap. Ew, what a pig. Okay, let's go into Snap here. This really isn't doing anything for you anymore in Snap, this 12-cent call. So we're going to go ahead and we want some more monetary value to offset this offset these shares, because the 12-cent call, we've already appreciated 80% of the value of that contract. So it's really, we're basically just long the stock at this point, and this short premium isn't helping us anymore. So what would we do to fix that?
What was the question?
How much is this 10 short call worth?
Bought it at $3.
What's it marking at? What's the price of it? How much is it worth?
Snap's marking at 739.
The call.
The
You're
call
looking
is
at the
marking
shares.
12 point or 1.25 or 0.125.
12 cents, right? 12 and a half cents. That's not enough credit to offset $700 in risk. So that's not enough value left in that's really going to have any type of impact on that position should the stock continue to fall. It's only giving you 12 additional cents of protection, or $12 of protection to the downside. And this is a $700 of risk that you have in here, $740. So $12 of premium to offer as a buffer to the downside doesn't really give you much protection. So how do we fix that?
Buy it back and sell it close to the money, or closer to the
Yes. Yes, that's one way we can fix that, is buy it back. But first, in order to do that, we need to see where we're at in this position. So originally we bought the stock for $8.50, right? Go back to, so originally we bought the stock for what price? 850. Scroll over to trade price. 850, and we sold something worth 65 cents against it. So that puts our cost of the stock at what?
780, something like that.
Yeah, 785, right around 785. So we can move this down. That it's important to know that, because you don't want to roll this down to the point where you're locking in a loss. You want to give yourself room for profitability. So we can roll this down to the 8 strike in the same expiration, collect a credit, and still have room to make a profit. Or we can roll this to the 8 strike in the December expiration, collect a much bigger credit, or even just leave it at the 10 if we can get enough credit out in December. So look at both of those options. Taking it from the 10 to the 8 gives us what?
10 to the 8.
The 10 to the 8 gives us about 30 cents or so, 32 cents.
Yeah.
Yeah. Okay. I like that a lot better than I like where we're at now. Let's see what December looks like.
30 days out, does that work? Or further?
December, the monthly, bud.
44.
Yeah. So 62. All right. So I don't like. No, you did a buy. That was not a sell. I don't think that was a sell, was it?
Yeah.
Oh no, you did. My bad. I don't like that. I don't like taking the risk out that much longer for and only getting an extra 10 cents. So I would do it in the near term cycle. Yep. Give you another 32 cents. You understand why we did that in the near term cycle, not in the far term cycle? Because basically you added 30 days on it and you were only paid 10 cents for those 30 days, right?
Should we
Does
go
that make
back?
sense what I'm saying?
Um, think.
So go back into Snap. You open up the options chain and look at the price difference between the 8 call in
It was 20. It
November.
was 20 cent difference.
20 cents difference. Okay. Well, I still don't like that very much because, in fact, that's probably a good, actually, like a calendar spread in there. I still don't like it because you're adding, like, look at in 16 days, the contract is going to lose 45 cents in value one way or another. That extrinsic value is going to be gone in 16 days. That 45-cent value that it's currently worth for the 16-day cycle, right? In 44 days, it's only worth 62 cents. So less than 20 cents more for an additional 30 days. Proportionally, you're not being compensated very much for that additional time. So I would rather keep it in the near term cycle, see what the stock does, and then adjust further based on that.
Okay.
Make any kind of sense, or am I just speaking
Um,
French or
I mean, sure.
German? All right. So the other one that needs adjusting is MU. So go ahead and open up MU. You see how you're actually making money in here. You've made a lot of this money back. I made an adjustment in here yesterday because this stock moved pretty significantly, and a lot of your premium came in yesterday. You were getting tested to the downside. We had a big. You were getting tested to the upside. The stock kept rallying and rallying. We had a big down move yesterday. So you made a lot of that money from the short call came in, and you made a decent amount of it back yesterday. So it was at a good place where I could roll out your risk and get further away from the money. So I did that for you. But now, what we're running into is lo and behold, we're rallying like crazy again today. It's up like $18 today. So we need to roll this put up.
Wait, wait.
So you're short delta in here, you're short 9 delta. Let's try and collect at least 5 delta or 6 delta, kind of flatten out a little bit in here. So go, where's your deltas on here? I can't see your deltas.
I think it's
It's
this
to the
one.
right
Yeah.
or left. Not your, point 0.9. So you want to go up to like the 15, which would be to 205 or so. So go back, buy back your 195, sell the 205. What does that give you as far as credit? $1.25. Man, that's not much credit, but okay. Send that through. All right. Now you're sitting at -3 delta. All right. That's cool. Now you have a little bit more significant premium that's going to be working on both sides. MP. This thing is pure garbage still. Um, it's up to you. I was thinking maybe it's time to actually roll this down aggressively and go inverted on it, but I'm not sure. I want you to add something to your list here. So go to your cogwheel and then type in EXT and then click that. See where it says extrinsic, the first one, and that. Now go over, this is going to be really useful to you in the future. So like, remember we were talking about in the money, out of the money?
Mm-hmm.
You got one of these contracts that's really deep in the money, which is the one that expires in 72 days, the one that's worth, go back to your value. The put is worth like 20 some dollars, $22. So go back over to your extrinsic. This is going to tell you how much money is left in time value in this contract. So of that $22 in value that it's currently trading at, $2.75 or $275 of that is extrinsic value. And then of the other contract, all of its extrinsic value. So you'll notice that this 192, if you scroll over to the left, is going to be the price of the contract. 192. So all of that's extrinsic. So, but that's going to be helpful in determining, all right, is this really worth it to keep this on? How much total extrinsic value am I working with? So let's go and go back over and look at it again. What's the total of that? So we're looking at about
These two combined.
450. Yeah. So it's about $450 still in extrinsic value. I wouldn't be opposed to rolling this down to like the 70, but you could also leave it. I'll leave that up to you. You're definitely leaning really super long in here. But it's also beaten up. So, I mean, it's up to you. What do you think? These are the type of decisions that you got to make. So right now you're down $1,300. You have the obligation to buy the stock at $75, right?
Hmm.
Right?
Yeah.
So if you're down $1,300 now and you still have $450 of extrinsic value, what does that put you as an entry price for the stock?
I had a brain fart. What was your question?
You have to buy the stock at $75, right?
Yes. That's
You're already down 1,300.
okay.
But of the value of these contracts that are making up what you're down, 450 of that is extrinsic.
Okay.
So where does that put you buying the stock or your cost basis of the stock if you get assigned these shares?
900 something.
$950 below, or no, $850 below this
Yeah, 850.
75. Is that correct? Did I just lose my mind there?
850.
Yeah, 850,
13 minus 450.
right? 850. So really, you're buying the stock at 75, 65, 6650, 6650. I don't think that's right. Hang on. Did I just lose my mind? If we're buying it at 75, we're down $1,300. It's trading at 55. Yeah, that is right. You're buying the stock at 6650 effectively. So you could roll this down all the way to basically the 65. And that's going to give you a zone of profitability of around 65 to 75, somewhere in that range. Or you can just leave it, and that's going to move your zone of profitability. You're going to have the stock be higher in order to make profit, but you're going to leave yourself more room for a lot more profit. So basically, do you want to move and shift your zone of profitability lower? Or do you want to just give yourself more time and room to make more profit?
Give myself more time.
Okay, well, in that case, you don't do anything.
Alright.
Weevil, we're not touching that. Applied. You're finally in the positive and applied. So here's what I would do with applied. You have working orders in here. What are your working orders to close this at? Oh, you're just buying back to strangle. With applied, actually, this one's working kind of fine. I don't know that we do anything in here. You only have 50 shares. You're down to 16 days left. I don't think you do anything in there. But in AG, I think it's time to do something in here. So again, you're down $185 in here. Stock's trading at $10.66. You have 38 cents left in this contract to make. So 38 cents. 150. So you can move this. You can really only move this to the 12 strike. What do you get in credit if you move this down to the 12 strike? That's not right. You did something wrong. You're buying both of them, I think.
Yeah. Right. Oh, it's because it wasn't over.
20 cents. Um, if this thing rallies back to 12, you're going to make $140 or $135. And then you're going to have a contract that's worth what? 58 cents. So you're basically only going to break even. So really, I don't think you can actually move this. I mean, you can, but you're basically going to be locking in a scratch if you do that. Um, Ew, gross. The only other option is to increase your size a little bit in here, buy like 50 more shares or 100 shares, and then you can sell an at the money to collect. What's the at the money? Hang on, what is the at the money trading for? No, what's the at the money call trading for? Get out of this.
39.
Oh, oh,
Yeah.
no, that's not the at the money. The at the money would be trading at like 11. What's the 11 call? That's the at the money. 89 cents. All right, yeah, go ahead. Yeah, do that. Go ahead and buy 100 more shares because it's a pretty small product. Now you have a little bit more capital freed up. $300. Go ahead, send that. Okay, now go over to your average cost of your shares.
Go to what?
Your average cost is now $12.85.
Where are you seeing that?
Oh, your
Oh,
trade price.
Trade price.
Yeah, it averages it for you. So you're at 12.85. So in order in order for you to have a to make $180, you only need an 80-cent move to the upside. So what was the 11 was trading for what?
89 cents. Yeah.
Yeah, I think so. Now roll your 13 all the way down to the 11 and then sell an additional 11. Hit 2 on that 11. -2. Yeah. Go ahead and hit next. $144. Yeah, that'll work. Because that means you have $144 now in new credit that you just took in, basically 180 total, and you still have an extra $60 in room for this to appreciate. So if you get a bounce back to 11 by December, you'll make about $60 in there. So yeah, you did take on more risk, but you brought your place where you can still make a profit down from $12 to $11. And it's still a relatively small product, so it's not like you're taking huge amounts of risk in there. They just had earnings and they got kind of clobbered on earnings, so they're down pretty big today. And then Archer, what do we got going on here in Archer? We're down $200, got 150 shares. What do you see right off the bat with the prices of these contracts in Archer? Kind of the same thing that we saw in Snap, right? Especially the one in November. You got 16 cents on $950 or $9.50 stock. So that's not enough credit. So we're going to need to either roll that down or roll that down and out. So I would probably roll it down and out, and I would go all the way to like the 11 or the 10, honestly. Probably the 11. No, I'd be buying back. No. I'd be buying back the one in November, not the one in December. The one that's trading for 16 cents there, yeah. And then I would be going out to December.
Oh, okay. And trading the
And
11.
rolling down to the 11. Yeah. So that's going to give you like an extra 56 cents or something. Yeah, 56. Yep. So now look up this. Here's how I look at this now when I'm looking at this new position. So I've got 150 shares. So I break it into 100 share increments. I have 100 shares effectively that needs to get back to 11. If that happens, it's going to go from 950 to 11. That's $150. You're currently down $200. But you also have 70 cents in credit in this 11 contract. So just those 100 shares, if it gets a move back to 11, that's going to account for all of your negative P&L, right? 150 plus 70 is 220. You're only down 201. Do you see what I mean there?
Hmm.
So look at the price,
Yeah.
950. To get to 11, that means it has to go up $1.50, $1.50 on 100 shares is $150. And then add the credit of 70, add this 70 cents in premium onto that.
Okay.
That's going to be 220.
Yeah.
Those 100 shares alone are going to bring you back into the positive, but you're also going to have those other 50 shares appreciating if we get that move as well. So you're going to make more than that.
Okay.
But that's kind of the way that I look at it. And that 50 cents in credit that you have, or 50 cents in premium that you still have in the December 12 contracts, is monetarily significant enough that I don't think you need to roll that one right now. All right. So while we were doing the show, we adjusted Archer, we adjusted AG, we didn't adjust Angel Studios, although that one's working for you today finally. We didn't adjust Applied Digital. We didn't adjust Bull. We did not adjust MP. We did adjust MU. Did we adjust? Did we adjust NVIDIA?
No.
No. What do you got in here? You've got 25 shares. I think you roll, honestly, you probably have too much long delta in this crap. We already went through earnings. I think you take your 230 down to 220 because you got 25 shares and the 180 call is worth more. So you're sitting long in both your shares and your strangle. There you go.
Is that good?
Yeah. Yeah. This is going to flatten that position out a little bit and take you from like 20 some delta down to 13. I like that better.
Mhm.
Yeah. Okay. So now we adjusted it. NVIDIA didn't adjust the Palladium. Snap, we adjusted that one, rolled down the call. I think Snap has earnings coming up very soon, actually. And then Tesla, what a rally from Tesla today. You're making back some of that money. That's good for you. We didn't adjust that one though. And then we did adjust your Russell. You have 11,600 available to trade with still. So I don't think we do anything else.
Okay.
Did you find anything helpful? Did you learn anything? Does it make sense, a little bit more sense about how kind of my thought process goes when I get to like, especially with Archer and Snap, when you get these contracts that don't have enough value to do you any help, should the stock continue to go down, it's time that you need to stay mechanical and get more premium collected against your risk. Because your risk is you own the stock goes down.
Mm-hmm.
And then are you also kind of figuring out based on how much money you've made or lost where you can adjust things to and still have room for future potential profit? Are you getting that math at all?
A little bit.
I think the more that we do it,
Yeah, yeah,
and
used to it.
and yeah, and I think we're gonna have to have you start leading some of these at a certain point, maybe on Friday or next week. You'll have to start just doing the analysis on these and telling me kind of like what your thought process is and whether or not you want to adjust it. And then I can just chime in whenever you're doing something very badly. But all right, that's it. It's once again, this was Wednesday, November 5th. Noobs. Thanks for tuning in and watching. Hopefully the quality of the stream was a little bit better today. We're going to keep working on that. Eventually, ideally, everything should be, 4K and excellent quality, but we still have a few more bugs to work out as we're figuring this out. So thanks for watching. Tune in next time. Don't forget to like and subscribe and check out the Discord if you get an opportunity. See you next time.
Another day at the chart, a sea of red, talking puts and calls, but they just stare ahead. Strike price means nothing in the black mines, margins and leverage like mountains to climb. Spent the whole week on Delta and Greeks. Gamma theory ain't cutting through their peaks. Volatility shakes, but they don't feel the quake. Future contracts blur on this financial break. Can't you see the candles rise and fall? Risk and reward, it's a game of all or no. Options open, futures closed, eyes blind. Frustrated fathers dream in the stock grind. These bleeding specs, faces blank as empty streets. Hedging positions, but the questions repeat. Time decay means nothing to the young souls. In this marketplace, it's like digging holes. Iron condor flies, but it never lands. They can't grasp the feel of these trade winds. Liquidity try choking on the sand. Profits and losses, they'd rather go play bad.